Now welcome on board Hiren Ved, Director and Chief Investment Officer at Alchemy Capital Management, joining in right here in our studios. Hiren, hi, good to have you on the show.
Thank you.
Kunal was actually just pointing out, for the last 28 days, the Nifty has pretty much done nothing. We've just beat around in a 600-odd point band, maybe few odd days here and there of upside or downside, but just nothing at all. What's that telling you?
What it's telling you is that the markets are, probably stuck in this range because of what we are seeing on the geopolitical front, right?
They should be reacting, right?
Yeah, I mean, so there are opposing forces,
Yeah.
correct? I think it's been pretty resilient, the markets, in the face of what we are seeing globally. And I guess that there is, a little bit of the confidence that is coming back from the fact that finally in the Q4 earnings, we've seen at least earnings stabilize a little bit, right? And, typically in the short run, while the markets tend to focus on a lot of narratives, like we saw in the case of tariffs, I think what the markets want to see is that if, because of all the geopolitical situation, unless oil goes above $85, I think we'll be okay, right? And I think we should see a better earnings picture next year. I personally feel that given the level of monetary policy action that the RBI gave, had it not been for this geopolitical issue, my sense is that the markets would have probably broken out on the upside, right? Because it's a fairly strong monetary stimulus that you've given to the economy. Unfortunately, it all got kind of cancelled out in the near term, diluted in the near term because of what we are seeing on the geopolitical front.
Yeah. So that's the groundwork, which all seems to be backing us right now. But there are things in the market which keep happening, which kind of question what's the take on valuations right now. I was just looking at a data point that promoters, private equity, venture capital investors, they've sold nearly 40,000 crore worth of shares in just the month of June. I mean, is that, and sometimes at very steep discounts as well, which kind of makes you raise your eyebrows like, why at this price? Is that telling you that there is some concern on valuations?
Well, I think, the level of supply is definitely a concern in my view in this market. But it also tells you the psyche of most people who are selling, because they believe, like we said in the beginning of our interaction, that market should have corrected by now. Yeah. So people feel that, okay, this is a God-sent gift. Let's take some money off the table. Let's create some liquidity. And there has been a barrage of supply ever since we've seen a pickup in the market from the lows of, March and so on and so forth. But I think that also, apart from other reasons, this is also one of the reasons why the Nifty is stuck in this range, because there's a barrage of supply that's coming in. And when I speak to brokers, they say that this is just the beginning. There is a whole line of more supply that is likely to come up. In a way, it signals the depth of Indian markets now. But I think we should be very careful because, and especially in companies where promoters are just selling because the price is good.
Yeah. Okay. So that said, as an Indian investor, you're wondering what is it that you do? Because at one level, the psychology tells you that there should be panic and, everyone's selling. So you should be careful. But at the same time, the valuations are not really comfortable. We're not at cheap levels as we were, March lows. And that was also, now in retrospect, you think it was a very short window. The markets corrected and very swiftly came back up as well. Yeah. So how is it that you position yourself for the year ahead? At the same time, you have the overhangs of all the geopolitical concerns and tariffs. You still don't have clarity on tariffs.
Correct.
It may be headed in the right direction.
Correct. So I think you rightly mentioned, right? I mean, the market isn't really cheap. and I think that what is seemingly cheap, there is no growth, right? So if, let's say if you take the fourth quarter numbers itself, and we were doing some analysis that, the large cap definition as per Amphi, which is probably the top 100 companies, right? The PAT growth was 7%. But if I take out the next 50 and just leave the top Nifty 50 companies, it was 3%. That tells you that your top large cap companies, there is no earnings growth. On the mid cap side, in Q4, the earnings growth was 28%. And on the small cap side, it was 18%, right? So really what the market is telling you is, while most market commentators and strategists are telling you that stick to large caps, because that's where the value is, the problem is that there's no growth in earnings there. That's why probably they are available at the valuation at which they are available. But equally the dilemma is that if you want to buy where there is growth, you have to pay up, right? So I guess we are in this nice little equilibrium where I think we should stay invested. But having said that, I think there are always bottom-up opportunities that are there. There could be sectors where there is a lot of pessimism priced in. Pharma could be one of them, right? Chemicals also is coming off a very low base. So there can always be one-off opportunities that you could find in this market as well. While at a very broad level, we might be thinking that valuations are full up. But this is a stock-specific market in my view.
All right, stock-specific market. But Mr. Ved, in this recovery of the markets back from March and April lows, financial as a theme was the key consensus buy that most of our experts were highlighting, and the fact of the matter was the cheaper valuations as well.
Consensus doesn't work, right?
So that's what we want to know, that what will work now.
So I think, again, this debate has been around for a long time, that the large private sector financials is where the value is, or where the valuations are reasonable, which is true. But I think it really depends on, in your mix of portfolio, what do you want to, what's the average growth that you are looking at, right? If you look at the latest numbers, credit growth has slowed down to like 9%, right? So maybe the efficient private sector companies can grow at 12-13%. But our sense is that, while the RBI has given them the ability to fight off a reduction in NIMs because of the CRR cut, but unlikely that unless credit growth picks up in any meaningful manner, that we could see early teens kind of growth in earnings there, right? On the other hand, if you look at the capital marketplace, I think there is a structural story there. And those have actually done far better than the big private banks. So our sense is that, there is this hindsight bias that we have because for such a large, weight in the index, and therefore these big banks keep looking cheaper to us. But if you look at the last 3, 4, 5 years, they haven't really delivered the kind of returns. I think the capital market players have done far better, and that's where we are invested, frankly.
Okay. But there too, the valuations are not peaked out. And, when I ask the question on valuations, you're like, who's to know what's the correct valuation for these stocks?
I think the right way to look at it in terms of valuation is to not just look at absolute P, but to look at PEG, right? So if earnings are growing at 50% or 30%, and then if you end up paying 30 times, I think you're still okay, versus paying 18 and 20 times for 10% or even lower growth, right? I mean, if you look at it, Nifty trades at what, 23, 22 times 1 year forward, but Nifty earnings growth is 10 or lower. So what peg are you paying for the Nifty, right? Again, I mean, like this is just again a very simplistic way to look at valuation. So you need to look at the quality of the business, the longevity, and obviously there are risks when you pay higher valuation because any shocks that you might get on earnings, you are likely to see a significant drawdown, right?
Or something like an expiry date change as well.
Yeah,
can,
I mean,
bring about some shake-offs on an intraday basis.
Correct.
Yeah.
And actually that's exactly what we saw in Jan Feb, which is that the largest correction happened in areas where the participation was the highest, right? And also those were the companies that were growing. So I think there was a wave of whatever you call it, profit booking, precautionary money taking off the table, taking some risk off the table. I think, when we were looking at it, the next 50 index corrected much more sharply than the Nifty 50.
Because
right?
that's where the money
That's
was
where
made.
the money was made, and that's where the earnings growth was. So that's where everybody, had their exposure, and that's where the exposure came off significantly. So I think that from here on, given the broad valuations, we should have reasonable expectations of returns. And we are very clear that, money is to be made in the broader markets, not so much. I mean, probably barring Bajaj Finance in the top Nifty 50 and maybe companies like Trent and a few handful of ones which can still talk about compounding profits at 20-25% plus. Everything else is in single digits or early teens, right? So I think we have to moderate our expectations of growth. If we want to have lower risks, then you have to moderate your return expectation as well. And if you want higher returns, then obviously we will have to pay up for the growth that we have. So that's where I think we are in the markets today.
Okay, so let's take it one by one, and then let me start off with the capital markets theme. Would you be willing to put fresh money to work right now? And again, within capital markets also, do you become selective or do you buy a basket of stocks? Of course, the top creme within that.
Yeah, I mean, I still feel that, while valuations are expensive, but there is a structural growth in those, right? So whether it is asset managers, wealth managers, exchanges, I still feel that there is money to be made there. So to answer your question, would you still deploy fresh money? The answer is yes, I would.
Great.
All right, but Mr. Ved, let's also touch upon some of the sectors within the broader markets where companies have already delivered well and they're still looking forward to great growth numbers. One of the case I believe is EMS counters, where Indian companies rather have showed what they can do and what they are capable of course with the government support. And the other one is the quick commerce place, where we have seen a bit of a turnaround as well in select companies. Do you believe it's still reasonable at these price points where the valuations are already stretched, but still it is the case where you can pay more?
So I think I agree with you. I think EMS is a great growth opportunity still. I think we are in the early stages of a growth cycle, right? Probably with the exception of Dixon, which is just about going to reach 1 lakh crore of market cap, right? A sector which is so large and the opportunity which is so big. I think you will see the birth of many large companies there, right? And yes, the valuations are quite punchy, but you will have to therefore elongate your time horizon for investing. Having said that, I think we have to be careful because, a lot of the growth is in the price and valuations, right? So unless you are really willing to bet for the next 3 to 5 years and wait for that growth to unfold, there could be intermittent quarters where the numbers may or may not pan out to be good, and you could have a very significant drawdown in these kind of names, but on a structural basis, I still believe there is money to be made. It's a young sector in India, relatively.
What about e-commerce plays?
On quick commerce, I think it's, we are at an interesting juncture where, you have 2 or 3 people jostling for the market, right? I think the players themselves are surprised at the kind of growth that we've seen in the quick commerce segment. I think that for some more time, the competitive intensity is going to be much higher. So again, while companies will achieve scale quickly, but whether they can achieve profitability quickly is yet to be seen. It's a large opportunity, and my sense is that in this, it will be the winner takes it all. So whoever is number one will probably get the disproportionate part of the valuations. And for the rest of the players, I think while they can be happy saying we do quick commerce, but there'll be no quick money to be made there.
Kind of reminds me of telecom, that the one with deep pockets, the one with the spending power is going to win the game.
Correct.
Yeah, absolutely. And just so much competition now, because everyone's realized that the pie can be shared.
Yes.
And, everyone from a Rapido to Amazon, and you keep hearing new names on a daily basis. So I don't think that, the prime position that Eternal had again, and I think the stock price is pretty much reflecting that.
Yeah.
It's
I
going to
think
be a while before it gets
people are
back,
waiting and watching to see who's going to come out trumps in this game.
Yeah.
And I guess you'll have to wait for a couple of quarters to get that answer, right? Because everybody is fighting for that pie. So in the near term, it's anybody's guess.
Yeah.
Let everybody burn their money and then we will
and
see
then
what happens.
Who's left. Yeah. But I want to get back to the sector that you were talking about earlier, pharma.
Yeah.
There is that big overhang on, Trump's tariffs there as well. But, and of course, they keep propping up all those US FDA issues as well.
Yeah.
But where is it that you see opportunity within pharma? Stick to generics, go for the new fads, biologics, GLP-1, etc.?
So I think, broadly, again, pharma is very different. You have to be stock specific. But I'll tell you very interestingly, I was in the US, one of the sell side firms, they do a conference every year. And I thought, let's go and, get some perspective of what is happening. And my sense is that there is this sword hanging about tariffs, right? The sense I got was that, it's unlikely to significantly change the long-term potential of Indian pharma companies. Even despite everything, it is going to cost 5x to 6x to manufacture in the US versus to manufacture in India. So when it comes to generics, my sense, or at least the sense we got, was that the higher tariffs, if at all, will be passed on to the consumers, because anyway generics, the competition and pricing are so low that there is no room for companies to absorb any more costs. And I also heard some companies saying that if it's too unprofitable, we'll shut down production, right? So there could be shortages. Yeah. So I think on the generic side, less likely that tariffs could impact. Having said that, I think, will some manufacturing shift to the US? The answer is yes. Longer term, is it going to be a challenge for Indian pharma companies? Absolutely no, in my view. And I think Indian pharma companies are very smart. Some of them will set up, end finishing or formulation plants in the US. You can't topple competitiveness, and you can't change years of global supply chain overnight. So my sense is that this will also blow over. And in fact, I wouldn't be surprised that, after whatever tariffs that they have to put in, after the initial shake-off, actually stocks will rally hard in pharma, in my view.
Interesting. So, realistically, where do you think in the market in the year ahead will there be alpha generation, or should one give up hopes?
One should never give up hope. No, I think, okay, so, we mentioned about what the RBI has done on the monetary policy, right? And the very obvious names that come to people's mind are NBFCs and stuff like that. But I think one name which I think is still underappreciated and which could be a big beneficiary of better liquidity and falling rates is real estate. I still believe there is a lot of alpha to be generated in the real estate companies. Look at the latest numbers that DLF came out with, right? I think that, and I've said this before, that the total representation of real estate in the market cap is still way too low, just 2%. If you add up even the top 10 companies by market cap, I think the number doesn't even add up to 6.5 lakh crores. For an asset class which is so large and for companies that are doing so well, I still believe that there is headroom for growth there. So that's one area that we are very bullish on in the listed space, but mostly premium, not affordable real estate. I think that's where the demand is, that's where the pricing power is.
That's where the margins are.
Exactly. Selectively, there would be opportunities in chemicals and pharmaceuticals. And then we still continue to be very bullish on capital goods, right? Power, defense. I think the entire capital goods space corrected very sharply in the last 6 months, after September actually, because government spending was very low and stocks corrected 30-40%. I don't know how much people have looked at it, but in March, the capex figure was 2,40,000 crores. So they finally ended up spending the 10.2 lakh crores that they had budgeted for. Yeah. And I think they are pretty serious that they will end up spending 11.2 this year, right? And the beauty is that for the next 6 months at least, for the first half of this year or even up to December and I would say even up to March, you have a very low base of last year. So this year the base would look much better. So I think that many cap good companies who are still trading below the peaks that they had reached, let's say last year between July and September, I think there is some space for a lot of ground to be covered there as well. So I would say real estate, capital goods are two areas, selectively specialty chemicals, a few pharma names. I think there's still money to be made.
Great. So just getting back to the cap goods point, stick with the leader or look for bottom-up stories as well?
So again, like we like the entire power space, right? And also the top 2-3 multinational cap goods companies. One of them had a split, so I guess there is price discovery today. But I think ABB, Siemens, Hitachi, GE, again we have exposure to all these, so this is not a recommendation and a disclosure from our side, but we still love all these names.
Okay, here's to alpha then.
Yeah.
Right. Great speaking to you, Hiren.
Thank you so
much for your
Bye-bye.
time.
Thank you.
Okay, let's